Most people believe the stock market is risky and unpredictable. But what if I told you it's actually hard to lose money if you follow a disciplined plan? Today, I'll show you 10 practical rules inspired by Warren Buffett's wisdom that can help you protect your capital, avoid mistakes, and build long term wealth. Let's dive in. Rule number one: Warren Buffett Golden Rules. Warren Buffett, one of the world's greatest investors, has two famous rules. Rule number one: never lose money. Rule number two: never forget rule number one. This doesn't mean stocks never go down. It means avoid permanent loss by investing in solid businesses and staying patient. Buffett focuses on companies with strong fundamentals and durable advantages, so time works in his favor. Second, don't day trade. Day trading involves frequent buying and selling within a single day, often chasing small gains. It's extremely risky, requires skill and discipline, and studies show only about 10 to 15% of day traders succeed long term. On top of that, avoid using leverage or margin. Borrowing money to trade magnifies both gains and losses. But in reality, it usually wipes investors out when markets swing the other way. Leverage is like playing with fire. It can burn your entire portfolio. Instead, focus on long-term investing, where patience and emotional stability are your real secret weapons. Third, only invest money you don't need for at least the next 2 years. Think of the stock market like planting a tree. It needs time to grow. If you plant it today and dig it up tomorrow, you'll never see the fruits. When markets dip, and they will dip, you won't panic if you set aside money you don't immediately need. This gives you holding power to ride out volatility instead of selling at the worst possible time. The truth is, short-term investors often let emotions control them, while long-term investors let time work in their favor. Remember, the market rewards patience, not panic. Fourth, invest in companies you truly understand, businesses that are part of your daily life. If you can explain how a company makes money in 1 or 2 sentences, that's a good sign it's within your circle of competence. For example, in Singapore, think of SBS Transit, which moves millions of commuters daily, or Sheng Siong supermarkets, where families shop for essentials every week. These aren't speculative fads. They're businesses people depend on rain or shine. When you understand a company's products, customers, and role in society, you'll feel far more confident holding it through ups and downs. Investing shouldn't feel like rocket science. It should feel like common sense. Fifth, before you buy any stock, you must study its fundamentals. Think of this as doing a health check before committing your hard-earned money. Look at the balance sheet strength. Does a company have more assets than liabilities? Review its growth track record. Is revenue and profit trending upward, or is it shrinking? Check debt levels. Too much borrowing can sink a company when times get tough. See how much cash it has on hand, because cash is a cushion during downturns. Don't forget dividend history. Steady payouts often signal a strong, reliable business. And finally, assess the management team. Are they capable, transparent, and consistent in delivering results? Mark down the company's quarterly earnings dates. 2. This forces you to review its performance at least 4 times a year, based on facts, not daily market noise or headlines. 6. Decide what type of investor you want to be. Are you chasing growth, or are you after dividends? Growth stocks reinvest their profits to expand. Think tech companies building new products or entering new markets. They don't usually pay dividends, but the value of your shares can multiply if the business grows successfully. On the other hand, dividend stocks reward you with steady cash payouts, like a paycheck for simply holding the stock. These companies are often more established and stable, appealing to investors who want consistent income. Neither approach is better by default. The key is aligning your choice with your financial goals, risk tolerance, and time horizon. Ask yourself, do you want compounding growth for the long term or reliable cash flow today? 7th, never buy a stock just because it's trending or because everyone else is talking about it. Popularity is not a strategy. Instead, write down at least 5 solid reasons why you're buying. Maybe the stock is undervalued compared to its true worth. Maybe it shows consistent earnings growth. Perhaps it offers a steady dividend stream, has low debt with strong financial discipline, or operates in an essential industry like food, transport, or healthcare. By writing down your reasons, you create a logical checklist. Later, when markets get emotional and prices swing wildly, you won't be swayed by fear or hype. You'll revisit your list and stay grounded in your original strategy. Eighth, always invest with the end in mind. Too many people rush to buy stocks, but never think about when or why they would sell. That's how emotions take over. Instead, set clear rules before you even hit the buy button. Decide, how long will you hold the stock? Are you in it for years, or just until a milestone is reached? At what gain will you take profits? For example, do you sell part of your position after a 30% rise? At what dip will you cut losses? Not every investment works out, and protecting capital is key. What if the stock stays flat for too long? Will you rotate into a better opportunity or keep waiting? And most importantly, never sell a loss just because of panic. Only sell if the fundamentals truly change. If the company's core business weakens, debt spirals out of control, or management loses credibility, then it's time to move on. But if the business is still strong, patience often rewards you with recovery and long-term gains. Ninth, treat investing like a science experiment. Write everything down. Keep a simple spreadsheet or journal with your research, your reasons for buying, your price targets, and your exit plan. This does two powerful things. First, it keeps you accountable. You'll know exactly why you made each decision, instead of relying on memory or emotions. Second, it helps you learn. Over time, you can look back and see what worked and what didn't, turning mistakes into valuable lessons. Your spreadsheet becomes your personal investing playbook, proof that your choices are based on logic, not impulse. 10th, once you've done your homework and bought the stock, your job is simple. Hold it and ignore the noise. Checking prices every hour won't make you richer. It will only make you anxious. The market swings daily, but those small moves don't matter to long-term investors. What matters is whether the business is still strong. So, turn off the noise. Ignore headlines screaming about crashes, political drama, or fear-driven predictions. Review your stock only during quarterly earnings reports, when real data comes out. Then, go back to your spreadsheet. Does the stock still meet your reasons to hold? If yes, stay the course. If no, adjust your plan. Remember, wealth in the stock market is built not by reacting to every headline, but by staying calm, patient, and disciplined over years. So here's the truth. With patience, discipline, and a clear plan, it's actually difficult to lose money in the stock market. Protect your capital. Choose businesses you understand. Set your rules, and ignore the noise. That's how ordinary investors build extraordinary wealth. If you found this helpful, hit the like button, subscribe for more, and comment below. Which stock would you apply these 10 rules to first? Thanks for watching.